almost. Hey everyone, it is Niki Shelton, and we are keeping it real. And I am here with Kerri Selby. Kerri, how you doing today?
I'm doing great. We were just catching up on your new addition to your family.
Yes, we were. She's a cutie. Yumi Maggie is her name, and she's a mini Australian, and we're so thankful that she's in our lives. So, anyway, how's it going on your end? What's it like today in the weather? Tell me about the weather. I always miss the weather.
It's kind of gloomy. I look out and, I'm right on the water on Dyes Inlet, and there's a lot of fog right out there this morning. So, not so
So it
great.
almost really looks like your picture. And see, let's see
Yes,
if I can do this. See this? This is sun. Just so you
I
forgot what it
know.
looked like.
Just in case. We did have a couple
No,
nice days, and we're back to this. So,
well, I saw the beautiful sunrises and sunsets, and again, it's just gorgeous. But we've been getting like this frost in the morning. It's the coolest thing. Have you ever seen the Twilight series?
yes.
With okay, so you know what I'm talking about. So Edward, he's the vampire, and he goes out into the forest one day, and his skin's like glistening. It's just like beautiful and sparkly, right? Remember I'm talking about?
Yes.
So I went out for a walk, and it was about, I don't know, 26, 29 degrees, and there was this frost on the ground, like we get, but because of the snow and the frost on the ground, like everywhere I looked, it was like sparkles. It was the
Nice.
coolest thing to see. It was really pretty. So anyway, all right. So let's go ahead and do our intro because I didn't do it. And now let's get down to business. So we are going to be moving forward with loans today, and we went over conventional, we went over FHA, and now we're going to go into VA, which is, I love helping people with the VA buyers. I mean, these are some of my most favorite ones to do, and it's not because I don't love all people the same, but I mean, these guys and gals, I should say, not just guys, it's guys and gals, have given so much for us, and it's so cool to be able to do something to kind of help them and to see what they get to. So they're kind of one of my little heart things that I get to do, and I know that's important to you too, because my dad was military too, but you also have family who do military, so I know that's a special place in your heart as well.
Most definitely. And that's why I absolutely love doing VA and why I've learned so much about it, because my husband did serve in the Marine Corps for 24 years. And once they say, once a Marine, always a Marine, he's never an ex, he's never a former, he's still a Marine. And we have one son who followed in his footsteps and joined the Marine Corps. And we also have an airman. So very proud to have them both serving, as well as my nephew, who's also in the Marine Corps. So
yeah, and I have a nephew who's an airman. So that's kind of cool.
Awesome. I love it. I love it. And one of the things that I love is just being able to teach people about their benefit, because often they think that their only option is base housing, because rent does not always equal what it costs to live out in town. Because when you are in the military, if you do not live off on base, you get what's called BAH, or basic allowance for housing. So they kind of look at the area and see what the median rents are or median mortgage is. And that's how they come up with what you get for your BAH. A lot of times it doesn't cover it. And then you have to couple with that you're going to have to pay for utilities as well. And so sometimes you are coming out of pocket for way more than you want to, or are comfortable with, or actually can afford. So sometimes buying is a much better option.
Right. And then you can use that. I know I called you with a question the other night, but you can use that. Like, if you buy it, you can like sell and then reuse the benefit again, correct?
You can. It used to just be a one and done, but now you can restore what they call it is entitlement. And so you obtain a certificate of eligibility. One thing that we did talk about is that you are not eligible to even use your VA benefit until you have done at least 2 years of consecutive service. It's not graduate from boot camp and guess what? You can get a home through the VA. They want to see that you have a commitment to serving in the military. So if you get out after 2 years with an honorable discharge, needs to be honorable, you are able to use your VA benefit. Well, what is the VA benefit? It means that you get to come in
primary, right?
It can only be for primary residence. Correct.
Okay.
So If you've lived in it.
And that means you have to live in that house, right? Sorry, I'm just trying to make sure I'm understanding this. So you have to live in that house. That means primary residence is you have to live in that house. It can't be like, you're going to use it as a second, like investment home or a second property, correct?
So we'll get into a little bit of the logistics in just a minute, but when you first purchase it, you must occupy the home as your primary residence. It's most homes you need to move into within a certain period of days. With a VA, they understand that sometimes you are being stationed somewhere else, you've gotten orders, but then they get pushed back. Well, that means that your orders were put on hold and they're not going to send you maybe for another 2 months. Well, they won't ding you or penalize you for not moving in right away because they understand with the military, anything can happen. So you get to kind of waive that 60 to 90 day move-in time frame. So what it means to have a VA loan, great thing is that you can come in with 0% down. And that's
let me do that for you.
Yes. So no down payment is required. The good thing is it used to be if you had a loan that was higher than the conforming loan limit, you would have to come in with a percentage of the excess. So anything above that conforming loan limit. That doesn't happen anymore.
Okay, so let me make sure I'm understanding. Let's make sure I'm understanding because I'm going to go back to really basics here. So if I am coming in, let's say that I'm buying a house for $500, but I'm only eligible for $450, I would have had to bring in that $20,000. Is that what you're trying to say?
So the conforming loan limit is what the country has decided is the median home price. So the conforming loan limit currently is $766,550. So it used to be if you went over $766,550, you would have to come in with a percentage of the overage. So if you, that has nothing to do with what you qualify for, because if you don't qualify for more, then you should not be getting the house. It just means that if it's above that, it is considered a jumbo loan. So the interest rates are just slightly higher, but you wouldn't have to come in with any extra money. But you can go up to $2 million on that. And higher amounts might be available for multi-unit properties. That is one thing that you can do. You can purchase a home that has like an ADU or a duplex. You just have to live in one of the homes as your primary residence.
Okay, got it.
So credit score requirements, one of the lower ones out there is you can go down to a 580. It does affect your interest rate because you're showing that you're a higher risk for lending money to. So once you hit 620, it doesn't matter if you're a 620 or an 850, which is the highest, your rate will still be the same once you get past that 620. So the guidelines for credit are a little more flexible because they do understand that people get station places. They might go to a new place and not have received a bill. And I mean, nowadays things are on auto pay, so there's less of an excuse for missing a payment. But, if something wasn't set up correctly, they are a little more lenient with if you have a late payment or anything, they understand with a letter of explanation. If you, just tell them, I missed it because I got stationed in Japan unexpectedly.
Gotcha. So you guys, and I'm going to go back again, like what we were talking about several weeks ago. If you are in a vet or you're a military service person and you're looking at that and maybe your credit score is at that lower end, you want to talk to Kerri because she can talk, she can kind of help you and get through some of that. So maybe you're at a 580 right now, but you can maybe pull up to a 620 and get a better rate. So, again, don't wait, get those communications going with your lender or talk to a real estate person and talk like, who would you recommend to help me do this? Because that will make a difference. And so make sure you're having those conversations, even if you're like, I'm thinking maybe I want to buy in like 2 months from now or 3 months from now. Have those conversations with your lender now to see what your score is, what you can do to get on that path. So that way you're better off. Okay. That's my 2 cents. Go ahead.
And I love that. Thank you for putting that in there because we do have a soft credit pull that does not impact your credit score. If it is in that 580 range and we want to get you to a 620, I can run a simulator to see where we could be if we maybe pay down a balance a little bit. You just never know. Sometimes you just might be utilizing a little bit too much on a credit card and just paying $50 down on a balance could impact your credit score by 40 points. You never know. So that's definitely something we could play with.
So question, because you said a word I know we haven't talked about. I don't think, well, I mean, I know we've talked about, but we maybe haven't explained it. What's a soft pull versus a hard pull?
So a soft pull is just something that is done through my company. We are able to run a report through Equifax, Experian, and TransUnion. Usually we'll just pull one credit bureau because that gives us an indication of where your score is, and it reports most everything. So a soft pull just means we're just looking at your credit. It's not going to report to Equifax if we pull, or Experian if we pull a report. It's just taking a look at things. A hard pull is when you're ready to move forward. It's going to send an inquiry to your credit, which can sometimes lower your credit score temporarily. When you do too many inquiries, it can definitely impact your credit score. One good thing about doing a mortgage inquiry is they know when people are looking for mortgages, sometimes they shop. And so you have this 45-day window where no matter how many credit pulls you do, it's only going to count as one.
So you were reading my mind there, Kerri, because you know that was my next question. So you guys, so what you just said, let's reiterate this one more time. So there's a soft pull. So like, you just kind of want to do a quick check. That's not going to show up on your credit rating. If you do a hard pull, like you're really, it's time to do this. I want my pre-approval. We need to start getting our, really get everything together here because we're ready to make a move here. That's more of a hard pull. So that way, that will be on that will hit your credit, like she said. But if you are having other parties or whatever do that during that time for a mortgage thing, it's only one hit. So you only get hit with it one time, which is a good thing. And
within a time frame, though, it has to be
45
within
days.
45 days.
45 days. Yes.
So, just definitely want to put that in there. Because, when you purchase a car, they want to get you the best interest rate. And so you'll see they'll run your credit through like 9 different companies and you get hit with every single one of those. It's not the same. It's not the same as purchasing a car.
So don't purchase a car and do a house at the same time. That does not work.
No, not great. It's not great.
Talk to your lender about that before you do a car thing.
Talk to me about any major purchase. We don't want that happening.
Okay. All right. Let's get back to what we're talking about. So VA. So, okay. So you're going to do a soft pull. You see where they're at. You can help raise their score to hopefully get up to the 620. So it's a better rate. Okay. Let's do qualifying ratios.
So what that means is we're looking at your housing expense and all of your fixed expenses. That's what counts as your ratio. We're going to make sure that I don't really like to go high, but I have seen them go as high as like 59% of your gross income. That's very high to me. It's very uncomfortable. I don't like it, but if people say that they can do it, who am I to say anything?
So what you're saying there, though, is like how much money I would like spend per month on my mortgage. Is that what we're asking or we're talking about, right? So
yes.
Again, I'm trying to bring everything really back to kind of dumb stuff down. I know sometimes I just like, let me get this right. So what I'm assuming you're talking about here, and if I'm not, you definitely correct me. But what I'm seeing here is that you're saying you could spend like 59% of what you normally spend for your monthly expenses towards your mortgage, right?
So let me clarify. We have 2 different ratios when it comes to your expenses. We have the front end, which is what we call it, and that's just your housing ratio, how much of your gross pay you're paying for housing. And then we have a back end ratio, and that includes your housing expense plus any fixed expenses like car payments, loans, credit cards, and things of that nature. Anything that reports to a credit agency is going to be what we count as we'll just call it an all-in ratio, whatever your expenses are on paper. So that can go up. Most loan programs go up to 50% of your gross pay. So that means before taxes. But like I said, it can be very uncomfortable. The one way that's not really uncomfortable, going back to credit, if say that you are married to someone who does not have good credit, they fall at that 580 and you don't want them on the loan because of that. If they're not going to be contributing income, we can still move forward with a loan. We just have to qualify the veteran with any debt that the spouse has. So what that means is if they, you have $900 a month going out of pocket for your expenses. If your spouse has an additional $500 a month, we have to count that against you, even if they are not on the loan, because we know that you're going to have to help pay those bills, especially if that spouse is not working. So we want to really make sure that we're looking out for the veteran and looking out for affordability.
Because you really don't want to be in a situation where, the loan, you're paying so much money that you don't have money to live and to, I always tell people that, don't go so high that you're not comfortable, that you can't put money aside and have a savings. And, if an emergency comes up, that you can't take care of that kind of stuff, because it's so important.
Right.
So
very true. Very true. So
that's what I like about Kerri, because we have those conversations all the time. Is this a good spot for the buyer? Because I don't want them to come back and say, Niki, I don't like you because my payment's too high. So
Kerri pushed me into a payment that I'm just really not comfortable with. And that's really, I'll reiterate, I've always been about where are you comfortable payment wise versus what you're actually qualified for. At the end of the day, you have to make that mortgage payment every month. I don't. So you have to know what is in your budget and what you're comfortable with.
Yeah. And by the way, that's not a Stanley Cup. I can't. Yeah. No.
So you're not basic. Okay. Gotcha. You didn't fight for your cup. Awesome.
Just saying that. Don't want one of those.
That's so funny.
Okay. Let's talk about the seller concessions, because this is a thing that, sometimes you get sellers who are like, I don't want to have to pay the VAs, so I don't want to sell to a VA because of that. And it's such a bad reason.
Right.
And, and they do. The buyers or the sellers sometimes will have to pay. There's a certain thing that they have to pay for a buyer coming in that is a VA.
Yes, there are fees that are capped for veterans. So an origination fee has to be under a certain percentage. Their closing costs have to be under a certain percentage. We just want to make sure, once again, that we're protecting the veteran. And so they might ask for seller concessions. They can give a seller concession up to 4% of the sales price to cover closing costs. VA is unique in that if the borrower has debt that needs to be paid off to qualify, those seller concessions can be used to pay off debt. Very different than any other loan. That cannot be done with any other loan type, but it can be done with a VA, which is nice because, say that you're drowning in some credit card debt and you really want this home. If they are able to get, because honestly, your closing costs are not going to cost 4% of the sales price. They're generally not. They're generally about 2.5% to 3%. So whatever's left over can be used to help pay down some debt, which is really nice.
Okay. And they still cannot be used for buyer brokers commissions, but they're talking about doing possibly that in the future, though, correct?
I have not heard that, so I couldn't give that to you on authority, but I know that it cannot be covered currently. Right.
Okay. So again, let's briefly, I'm going to say this really briefly because we've talked about this before. So across the board, buyers and sellers each are responsible for their own broker or for their fees, their broker's fees. Most of the time the seller, or a lot of the time the sellers will assist, but they're not required to. That's not something that they have to do. So, buyer may have to come with those fees. And so having that extra percentage, even if it's helping pay for everything else and they pay for their own broker's fees, that's still helpful. So, but they can't pay for it out of the concessions, right? Did I say that right?
Yes, you did.
Okay, good. It's tricky and it's hard and sometimes it doesn't always come out right. So, okay, good. So anyway, all right, let's move on. So they can help.
One thing that's different between a VA loan and all others is that instead of having private mortgage insurance, there's a funding fee, which is a guarantee. If the loan goes into default, the VA guarantees the loan will be paid for. So the funding fee is based on how much entitlement you have. And what that means is the first time you use your VA benefit, you're charged 2.15% of the sales price of the home. That is financed. So it's unique that you can finance more than 100% of the value of the home with the VA. Only VA and USDA can you finance more than 100% of the home. So if you were to sell that home and buy another one, there is something called a subsequent use, which goes up to then 3.3% of the sales price of the home. Unless, I just keep on putting more stuff in here. If you get out of the military and you go to the VA with a claim because you received some type of disability, you got hurt when you were in the military, you no longer can stand for long periods of time because you hike too much in your boots, and so your feet kill you all the time, or you have PTSD, anything like that, you can get a VA rating for disability. If you receive a VA rating, you will be exempt from any funding fee, which is really nice.
So if you have any type of disability, not Correct. A certain percentage, it's any type.
Any type, yeah.
Okay, good to know. I didn't know that.
Yes. You have to have a letter and a rating from the VA, though.
Okay.
And it will show up when we pull. So we pull what's called a certificate of eligibility to see what you have available. And it will tell us on there if you receive any type of disability and what the monthly amount is, which is really nice. What some people don't know is that you can have dual entitlement. So this goes back to what we were talking about earlier, that the home has to be your primary residence. But because they know military moves around when you're still active duty, they know that you're going to be stationed somewhere else. But say, like for us, when we lived here in Washington, when we first moved here, didn't love it, but then we fell in love with it and we decided to stay. But say my husband got orders and wanted to go somewhere else, but we had purchased a home. We could still maintain this home because we want to move back to Washington because we really like it. So we could maintain the home and purchase another home at our new duty station with our remaining entitlement. Sometimes, depending on how much you have left over, you have to come in with some money. But if you have enough, then you can come in still with that zero down.
Okay.
So I just recently had this come up where somebody had entitlement used up, and I have a worksheet that I fill out, and it gives me a number of what they would have to come up with. And for this particular person, they wouldn't have had to come in with any extra money because they had enough entitlement left to cover the new mortgage.
So they could be renting out one house then if they lived in another house, but their intention would be to go back to the one that they're renting then at some point. Is that what I'm understanding?
You don't even have to have the intention to go back. You can just retain the property. Yeah. But just know that your entitlement is still tied up with that. So you won't have full entitlement back until you sell the home.
Okay. Gotcha. Okay. Makes sense.
So one thing, that's not unique is that gift funds can be used for the down payment. There's no down payment, but gift funds can be used for closing costs, which is really nice because often if the seller can't give a concession and you're really tight on money and you need like an extra $500 or $1,000, you can receive gift funds from a family member or a nonprofit like a church or something like that as well.
Okay.
So it goes over the things that we talked about: no second homes, no vacation homes or investment properties. There's no income restrictions at all. You don't have to be a first-time home buyer. And like we just covered, the VA loan can be used multiple times, but the funding fee just goes up for the subsequent use. Some people do, when they have sold a home and they have a lot of excess equity and they want to put money down on a new home, you can do that if you want to lower your payment. And if you are not exempt from the funding fee, it also will cut your funding fee down if you put a down payment on the home. So that part is nice. It goes from 2.15 down to 1.65.
Okay. Cool.
Yeah.
That's good. Okay. All right. Do we have time to go into the next one or should we put this off for next week?
I say let's go for next week because we're at almost 25 minutes. So
okay. Perfect. Okay. We're trying to keep this short, but we're also trying to make sure we get enough information that we really, are answering questions that people have, thrown at us occasionally or whatever, or just make sure that everybody's prepared for this stuff. So I like that idea. You guys make sure that you hit that like, subscribe, or follow button. Thank you so much for watching. We always appreciate it. And again, throw us questions. We're happy to help and see what we can come up with. Okay. Thanks for joining us today, everyone.
Thanks, everyone.